Hello, stand by everyone. We are just adding LinkedIn to the stream, and it looks like we've done that. So I'll get rid of this and say, hey, welcome to all of you. Welcome. Welcome to my live episode, my live stream, Be the Boss of Your Money. This is the show about personal finance, which covers things like borrowing, investing, budgeting. That's what we talk about. It's all about making you the boss of your money. Hey, that's a great name for a show, right? And that's what I want to do here every single day. So I bring to you the experience, the knowledge that I've accumulated in a 3-decade plus financial services career as a financial advisor and still going on. And I'll bring to you the challenges that my clients have overcome, how they overcame them, what I've learned, mistakes we've all made, and lessons learned from those mistakes. So we're going to roll a quick intro, but today it's about the doom and gloom that seems to be popping up all over the place in the financial news. You know, things are doomed. We're heading south. It's all over. How do we handle that? Because I think a lot of people make decisions based on headlines. So we're going to talk a little bit about psychology, how to deal with these headlines, and what we should all be doing and thinking. So we're going to roll a quick intro. This is going to be a good, fun show. If you have any questions, hit me up in the comments. You know, I love hearing from you. That is the best part about this. So here we go. Hey there, welcome to my live stream. If you're joining me right now, my name is Mitch Goldberg. You're watching Be the Boss of Your Money. It's my live stream about personal finance every Monday through Thursday at 4:30 p.m. We always have highlights also. So the next day I come out with a few of the highlights. I post them on my YouTube channel. If you're not there, the YouTube channel is called Client First Strategy. Check it out. Please subscribe. Take a look at past shows and the highlights. The highlights are typically 1 to 2 minutes, and they just basically boil the whole live stream down into a very brief amount of time and give you the real information in a quick, bite-sized, snackable form of video content. In any event, if you're listening to me now and there's no video, you're just watching on audio, you're just watching. If you're just listening on audio, let's say you're in your car and you're listening to the live stream, I thank you, and I will make sure I explain everything so that if you're watching this or just listening to it, you will know exactly where I'm coming from, what we're talking about, what we're doing. And what do you think about my new live stream setup? It's a little bit wider of a lens, angle, and I've got my microphone on a new boom arm, as you can see right here. Usually I have the microphone stationed here and upward, and now I have it up here. I think it looks pretty cool, kind of just hanging here from the ceiling, and it's a little bit more convenient. It gives me a little bit more room. A few more things to do for my live stream. This cable here is called an XLR cable, and this is I'm getting a longer one. It's going to be and it's going to get tacked up here. So you're not going to even see this. It's going to get tacked up here, and it'll look a lot better. But listen, it takes time. Rome wasn't built in a day, so I've redone my entire live stream setup, some lights, some accent lighting, but I still have camera 1, camera 2 going, and I still have camera 3 going. That's a pretty cool angle. I like that angle a lot. Gives you a little behind the scenes look. Okay, so let's do a quick deep dive into what happened today. Why was the market down? Everything seemed to be hitting record after record. We had 7 straight days of records, biggest winning streak, I don't know, since last year. And all of a sudden, the market looks a little bit weak. It looks a little bit toppy. I can explain this to you because we've been talking about this for a while, and we have talked about this for a long time about getting ready for the next downturn. Things are pretty good. What I said a few episodes ago is peak stimulus. So it looks like we're going to reach that deal on the the stimulus package for infrastructure. Okay. But what comes after that? It looks like once we get this infrastructure package done, That's probably going to be about it. So it looks like that could be the last big stimulus package that we get. And if that's the last one that we get, investors could start worrying that, well, what if we run out of stimulus and the economy is not strong enough to stand on its own 2 feet? And then others say the economy is definitely strong enough to stand on its own 2 feet. The Federal Reserve should stop buying its bonds. The Federal Reserve, the central bank of the United States, buys $120 billion worth of bonds every month. They buy them from banks, and then the banks get the cash, and then presumably the banks will lend out that cash or make sure their balance sheets are shored up, what have you. But the idea is to get that money into the economy through the intermediary, which is the banking sector. Federal Reserve buys $80 billion worth of Treasury securities and $40 billion of mortgage bonds every single month. So some people say we don't need that anymore. Why is the Fed doing this? And then some people say, the economy is strong enough to get the Fed out of this game of buying bonds. What really confuses me, the big story, I shouldn't say confuses. Nothing confuses me. I'm like, I get confused about things every day, just like you, but then I stop and I think about them. Why is the 10-year Treasury yield below 1.4%? I mean, the 10-year yield just keeps getting crushed. So many things are tied to the 10-year Treasury yield, in particular, mortgages, all kinds of loans. The 10-year Treasury yield, the 10-year Treasury that the U.S. government issues, 10-year bond, it's paying like 1.3 something percent now. And it keeps going lower. But why is it going lower if there's presumably so much inflation? So there's a battle here. In real life, that there's inflation. How could you not? Price of everything is going up. The dollar is just not going as far. You go to the supermarket, you're like, wow, I'm getting a lot less food for the same amount of money. Gas station, look what it costs to fill up your tank. So what exactly is going on if inflation in the real world is here, but in the, the esoteric world of financial instruments, the 10-year Treasury yield is telling you, don't worry about inflation. There is no inflation. Yes, you see inflation now, but it's going to go away soon. That's what the Federal Reserve has been saying. They're saying they're not so concerned about inflation because they think inflation will go away and start to go back down again. So who's going to be right? Is the stock market, the bond market right? Or are consumers going to be right? It's just a very difficult time to make a decision. But the market has been making a lot of new highs. The fact that the Dow backed off a little bit today by about 200 points. So I just got the thumbs up from a friend. So the fact that the Dow is down by a little over 200 points, it's not that big of a deal. Let's not take one down day and make a mountain out of a molehill. But there is some negativity. The headlines over the weekend, especially in financial news, have been pretty horrendous. And it's weird how it's actually quite normal how we go from euphoric to depression back and forth in the market. And right now, it looks like investors are a little doomsday-ish, even though the market didn't come down to reflect that. So is money leaving the market? So, if you take a look at SPAC stocks, a lot of them have tanked. If you take a look at the electric vehicle stocks, those have surged and then tanked. Crypto surged and tanked. Lumber surged and tanked. Still up from a year ago, but down by more than half from its high. It just seems like there are speculative pockets popping up all over the stock market, but then they seem to get taken care of. They get taken care of. Investors just move that money someplace else, but money is not coming out of the stock market en masse. It's not like money's going out of the stock market and going into money markets. Certainly going into bonds, but it's not stock money that's going into bonds, from what I can tell, because the stock market's holding up so well. And the mega cap stocks, like for example, Facebook, last week hit $1 trillion valuation. So the bigger getting bigger. The smaller ones have actually doing, smaller stocks have been doing pretty well also. So money's not leaving the market. And I think that's what investors are worried about, is what's going to get money to actually leave the stock market, instead of going from rolling correction of one speculative bubble and then another speculative bubble, like crypto, meme stocks, pot stocks, just pockets of speculation popping up, but it's not impacting the overall S&P 500. And why is it? Because investors are still throwing money into index funds every month, in their 401k plans. That's a big part of it. But nobody's willing to leave the party yet. So what gets people to leave the stock market, like in 2000 and 2008? Generally speaking, it's something we don't see in advance, or after we see it. Sometimes it's so painfully obvious what it is, and we smack ourselves for not having the vision to even see what's right in front of our face. Is it higher interest rates? Is it inflation? Is it just that valuations get too high and the last marginal buyer finally disappears, right? People keep paying out. People are buying stocks now, in a lot of cases, not as an investment, but they're buying stocks as for just no other reason except that they expect somebody else to pay more for whatever they bought today. I bought a meme stock. I bought a blue chip stock. You just expect somebody to pay more for it very quickly. A couple of weeks ago, actually it's probably more like 3 months ago, I made a video, spoke about this in the live stream. You take a look at all these pandemic stocks, the work from home, stay at home stocks that got killed. And I said we have a warning that they're going to get killed from the trading of these stocks. And they did. And they said, of all of these, the one that I think has the most sustainable business model is Docusign, because it's just, once you use Docusign, you never go back. People might watch less Netflix. People might watch less movies on Netflix. They might Zoom less. But Docusign, now you're not going to Docusign any less. But that stock just went from 180 to 290, up over 40% in such a short amount of time. And I think that's what people expect from stocks. If I tell somebody today, hey, you could earn 8% annually and maybe double your money in 10 years. A lot of people are like, nah, I'm not interested. I'm going to talk to the financial advisor down the street who thinks I could get there in like 2 years. Is that what it takes to bring on a new client? Like, you have to promise somebody that kind of return? It's just the environment we're in right now. I'll tell you what, I spoke to a reporter at Newsday. That's the main newspaper on Long Island. It's also nationally read and recognized, about SPACs, and my reasoning with, SPACs, special purpose acquisition companies, is that it's a sign of so much speculation going on in the market. All right, so let's go through a quick update on what I'm looking at, and what entails this day. Eddie, I see you out there. Thank you very much. Hey everyone, let me know where you're coming from. Give me one of these. This way I could see your name pop up. Give you a shout out, and if you have any questions, listen, ask me in the comments. I love that. So I'm going to do a quick share screen. Let me make sure I pull up the screen that I want to show you first, which is up here. I'm going to make it bigger before I pull it up on the screen. I'm going to go to screen 4, pop myself up here. Okay, so let's take a look at this. Okay, U.S. markets. Dow down 208. Big deal, down 0.6%. NASDAQ up 24 points. S&P basically, down 9 points, flat. Gold up a little bit. Energy backed off a little bit. The energy has been going up like every single day for the last 3 months. It's the fact that it's off a little bit today, I don't think really means that much. A lot of people still think it goes higher. Does it go higher? I don't really care. I know that sounds weird, but it's not my concern in life whether or not oil keeps going up or not. There's a lot of things that come and go with, rising oil, good for some stocks, not great for the economy. But if oil goes down too low, it means the economy is weak and there's too low of a demand for energy, so nobody's driving, right? So the VIX is up a little bit, so people are starting to get a little bit nervous. When the VIX goes up, that's the VIX right there. You see that? me see if I could highlight that. See that VIX 16? We see that go over 20. My sense is we're looking at a quick 5 to 15% drop in the stock market. And let's take a look at the Russell 2000. Okay. Russell 2000 down 31 points. Look, when the markets go up, the Russell 2000 usually goes up the most. When the markets go down, the Russell 2000 goes down the most. It's the small cap index, small cap stocks. Those are more sensitive to the U.S. economy. And the fact that they went down more than the other averages tells you that, people are a little bit worried about the economy. But what's the real deal is this. And this is the effed up thing of the day. Can I say effed up? I didn't say the full word. I just said effed up. The U.S. 10-year Treasury down to 1.34%, so below 1.35%. If we're all worried about inflation and too many dollars printed and too many bonds being created, then why the heck isn't the 10-year Treasury above 2%? Why is it so low? And this is the conundrum. And the bond market is signaling to us right now, we're at our peak. We're at peak stimulus. We're at peak fiscal stimulus from the government once we get this infrastructure package done, okay? Bipartisan infrastructure. Once we get that done, that's it. We're on our own. The extended federal unemployment weekly benefit goes away soon. No more big spending packages. And the Federal Reserve said that they want to start pulling back on their stimulus. So they've passed their peak of what they're going to do for the economy. So you take a little bit of a deep breath and say, yeah, I was really brave when I was saying that we don't need all the help from the government, from the Federal Reserve, and from Congress to keep the economy going. But now that we're actually at that point, you take a deep breath and you start to think, am I as brave and bold as I thought I was, right? So those are the big stories, and that's why the market is trying to find its footing. You got me on that? You have any questions, hit me up in the comments, okay? Don't forget, you can always connect with me on LinkedIn, Mitchell Goldberg on LinkedIn. Connect with me on Instagram at InstaMitchG, or at InstaMitchG. I'm on Twitter at Mitch_Goldberg. I have to do _Goldberg because there's like 500 Mitch Goldbergs in the world. You think you're unique until you go on social media and you realize how many people have the same name you have. Okay. Let's talk about inflation. Just a couple things about inflation, then I'm going to let you go. A little bit of inflation is good and it's expected. But if inflation is so high that it crushes demand from people like you and I, we just can't buy as much stuff because everything costs too much money. So we're going to have to cut back. Maybe instead of buying 3 new pairs of shoes, I'll buy 1. Instead of taking that 7-day vacation with the family and going on an airplane, maybe we'll drive someplace and just stay overnight for 3 nights. It's, people make decisions based on price and emotion, prices and emotions. I think emotions are more important than prices. And this is a big deal, the inflation taking place. Is it transitory? Does it go away? Do we get back to prices where they were before the pandemic? This all remains to be seen, but we just don't know. And sometimes the voices who say inflation is going to remain high and it's not going back down are louder than those who say inflation is transitory. We're going to go back and forth with this argument. And it's going to wreak havoc. So let me show you a couple of things. I think this is really the crux of the argument. Okay. So S&P 500 snaps 7-day winning streak. Dow falls 200 points. Okay. We had a 7-day winning streak. That's like, you don't get those too often. Maybe we had 10 of those in history. All right. The honeymoon is over for streaming services. And when you talk about streaming services, it's not just Netflix and Disney. It's Discovery. It's Time Warner. It's, there's so many. I can't even think of them. Viacom, AT&T, Comcast. How many could there be? There's so many. ARPU, you see that ARPU, average revenue per user. It's getting so you're looking at my screen? It's okay. There you are. It's getting so competitive that you have to wonder how many of these services do you really need, right? So thank you very much, by the way, Warren and Ian. Good to see you, buddy. Thank you very much. How many of these streaming services do you really need? I know in my household, I think we have 7 of them. We also have Hulu. It's really getting out of control. And now that the weather's nice and the pandemic in our part of the world is over, so we're not really watching these things anymore. Day of reckoning is coming for high-flying tech stock, Wells Fargo warns. Wells Fargo's chief strategist, Christopher Harvey, has a year-end target on the S&P 500 about 10% lower than where the S&P 500 is now. Tech stocks are too high. All the good news is factored in. No matter how good the tech sector is, they just can't fight the force of people going out again instead of staying home for the last year and a half on their screens. So these are just the negative headlines. Multiple market strategists are getting worried and believe all the good news could be priced in. That's a pretty scary headline, if you ask me. All right. So here's how you deal with these headlines. Okay. Can I tell you what the market's going to do over the next 6 months? Like I have my hunches, I have my research, and I put it all together and my experience, and I can come up more or less where things will be, subject to change because facts change. I change my mind. And as you get closer, it gets easier to forecast. And sometimes you're just wrong and you really have to do a full 180 in your forecast. But it's always about adjusting. You never have perfect aim. It's always just getting as close to the target as you can and keep trying to adjust. You deal with it by recognizing that you invest according to your time horizon, your financial goals, meaning when we talk about time horizon, we mean how long is it until you need a portion of your money. So if your retirement is 20 years away, then your time horizon is conceivably long-term, but not as long-term as it used to be. And then you might be thinking, I need to move some of my money into cash, or you have a child going to college in a few years, or let's say in a year. And that money you save for your child's college education, if they're going to need it in a year, in my opinion, that money should not be in the stock market. That should be in more stable investments like money markets, savings, CDs, cash equivalents. So let your personal finance guide you. If you are in broadly diversified investments. Now, diversification is a strategy that we use to minimize risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. But it does help prevent your portfolio from reflecting the absolute worst performing investment that you have. So diversify. Make sure that we've had a good rally, a huge rally, not just in the last year, but if you go back to the Great Recession, it's been one hell of a rally. So what you need to do is let your personal finance dictate how much cash, bonds, and stocks you should have. If you're an individual stock investor, if you're investing in individual names, you have an extra job to do, because now you have to more or less determine if your individual stocks are fully played out, have more room to run. It's a harder thing for individual stocks in terms of letting your personal finance dictate how much you should have in these stocks. If you don't have a strategy, let me know. But a strategy is more important than being right or wrong on your timing. Okay? Create a strategy, make it a process, trust the process, and surrender the outcome. The results will come down the road. So that's my story for the day. I'm sticking with it. So far, 2021 has been a fantastic year for investors. What the second half brings is tough to say, but expect more of what we had in the first half of this year. Lots of scary headlines, some pretty big down scary markets, some pretty big rebounds, and through it all, make sure that you're investing for the long term, rebalancing, remaining diversified the whole time. And whatever we have coming our way, you'll get through it as long as you have the time horizon to survive the downtimes. Thank you so much for watching. I'm Mitch Goldberg, signing off.